Part 4. Common Stock. Occasional outbreaks of those two super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable, and the market aberrations produced by them will be equally unpredictable, both as to duration and degree. Therefore, we never try to anticipate the arrival or departure of either disease. Our goal is more modest. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. As is written, little fear is visible in Wall Street. Instead, euphoria prevails, and why not? What could be more exhilarating than to participate in a bull market in which the rewards to owners of businesses become gloriously uncoupled from the plodding performances of the businesses themselves? Unfortunately, however, stocks can't outperform businesses indefinitely. Indeed, because of the heavy transaction and investment management costs they bear, stockholders as a whole and over the long term must inevitably underperform the companies they own. If American business in aggregate earns about 12% on equity annually, investors must end up earning significantly less. Bull markets can obscure mathematical laws, but they cannot repeal them. A. The Bane of Trading, Transaction Costs. It's been an easy matter for Berkshire and other owners of American equities to prosper over the years. Between December 31st, 1899 and December 31st, 1999, to give a really long-term example, the Dow rose from 66 to 11,497. Guess what annual growth rate is required to produce this result? The surprising answer is at the end of this essay. This huge rise came about for a simple reason. Over the century, American businesses did extraordinarily well, and investors rode the wave of their prosperity. Businesses continue to do well, but now shareholders, through a series of self-inflicted wounds, are in a major way cutting the returns they will realize from their investments. The explanation of how this is happening begins with a fundamental truth. With unimportant exceptions such as bankruptcies in which some of a company's losses are borne by creditors, the most that owners in aggregate can earn between now and Judgment Day is what their businesses in aggregate earn. True, by buying and selling that is clever or lucky, Investor A may take more than his share of the pie at the expense of Investor B. And yes, all investors feel richer when stocks soar. But an owner can exit only by having someone take his place. If one investor sells high, another must buy high. For owners as a whole, there is simply no magic, no shower of money from outer space that will enable them to extract wealth from their companies beyond that created by the companies themselves. Indeed, owners must earn less than their businesses earn because of frictional costs, and that's my point. These costs are now being incurred in amounts that will cause shareholders to earn far less than they historically have. To understand how this toll has ballooned, imagine for a moment that all American corporations are, and always will be, owned by a single family. We'll call them the Go Trucks. After paying tax on dividends, this family, generation after generation, becomes richer by the aggregate amount earned by its companies. Today, that amount is about $700 billion annually. Naturally, the family spends some of these dollars, but the portion it saves steadily compounds for its benefit. In the Go Trucks household, everyone grows wealthier at the same pace, and all is harmonious. But let's now assume that a few fast-talking helpers approach the family and persuade each of its members to try to outsmart his relatives by buying certain of their holdings and selling them certain others. The helpers, for a fee of course, obligingly agree to handle these transactions. The Go Trucks still own all of corporate America. The trades just rearrange who owns what. So the family's annual gain in wealth diminishes, equaling the earnings of American businesses minus commissions paid. The more that family members trade, the smaller their share of the pie and the larger the slice received by the helpers. This fact is not lost upon these broker helpers. Activity is their friend, and in a wide variety of ways, they urge it on. After a while, most of the family members realize that they are not doing so well at this new Beat My Brother game. Enter another set of helpers. These newcomers explain to each member of the Gotrox clan that by himself he'll never outsmart the rest of the family. The suggested cure? Hire a manager. Yes, us. And get the job done professionally. These manager helpers continue to use the broker helpers to execute trades. The managers may even increase their activity so as to permit the brokers to prosper still more. Overall, a bigger slice of the pie now goes to the two classes of helpers. The family's disappointment grows. Each of its members is now employing professionals, yet overall, the group's finances have taken a turn for the worse. The solution? More help, of course. It arrives in the form of financial planners and institutional consultants, who weigh in to advise the Gotrox on selecting manager helpers. The befuddled family welcomes this assistance. By now, its members know they can pick neither the right stocks nor the right stock pickers. Why, one might ask, should they expect success in picking the right consultant? But this question does not occur to the Gotrox, and the consultant helpers certainly don't suggest it to them. The Gotrox, now supporting three classes of expensive helpers, find that their results get worse, and they sink into despair. But just as hope seems lost, a fourth group, we'll call them the Hyper Helpers, appears. These friendly folk explain to the Gotrox that their unsatisfactory results are occurring because the existing helpers, brokers, managers, consultants, are not sufficiently motivated and are simply going through the motions. What, the new helpers asked, can you expect from such a bunch of zombies? The new arrivals offer a breathtakingly simple solution: pay more money. Brimming with self-confidence, the hyper helpers assert that huge contingent payments, in addition to stiff fixed fees, are what each family member must fork over in order to really outmaneuver his relatives. The more observant members of the family see that some of the hyper helpers are really just manager helpers wearing new uniforms, bearing so non-sexy names like hedge fund or private equity. These new helpers, however, assure the Gotrox that this change of clothing is all important, bestowing on its wearers magical powers similar to those acquired by mild-mannered Clark Kent when he changed into his Superman costume. Calmed by this explanation, the family decides to pay up. And that's where we are today. A record portion of the earnings that would go in their entirety to owners, if they all just stayed in their rocking chairs, is now going to a swelling army of helpers. Particularly expensive is the recent pandemic of profit arrangements under which helpers receive large portions of the winnings when they are smart or lucky, and leave family members with all the losses, and large fixed fees to boot when the helpers are dumb or unlucky, or occasionally crooked. A sufficient number of arrangements like this, heads the helper takes much of the winnings, tails the Gotrox lose and pay dearly for the privilege of doing so, may make it more accurate to call the family the Hadrox. Today, in fact, the family's frictional costs of all sorts may well amount to 20% of the earnings of American business. In other words, the burden of paying helpers may cause American equity investors overall to earn only 80% or so of what they would earn if they just sat still and listened to no one. Long ago, Sir Isaac Newton gave us 3 laws of motion, which were the work of genius. But Sir Isaac's talents didn't extend to investing. He lost a bundle in the South Sea bubble, explaining later, "I can calculate the movement of the stars, but not the madness of men." If he had not been traumatized by this loss, Sir Isaac might well have gone on to discover the 4th law of motion. For investors as a whole, returns decrease as motion increases. Here's the answer to the question posed at the beginning of this essay. To get very specific, the Dow increased from 65.73 to 11,497.12 in the 20th century, and that amounts to a gain of 5.3% compounded annually. Investors would also have received dividends, of course. To achieve an equal rate of gain in the 21st century, the Dow will have to rise by December 31st, 2099 to, brace yourself, precisely 2,011,011.23. But I'm willing to settle for 2 million. 6 years into this century, the Dow has gained not at all. It is likely that in a few months, Berkshire shares will be traded on the New York Stock Exchange. Our move there would be made possible by a new listing rule that the exchange's Board of Governors has passed and asked the SEC to approve. If that approval is forthcoming, we expect to apply for a listing, which we believe will be granted. Up to now, the exchange has required newly listed companies to have a minimum of 2,000 shareholders who each own 100 shares or more. The purpose of this rule is to ensure that New York Stock Exchange listed companies enjoy the broad investor interest that facilitates an orderly market. The 100 share standard corresponds to the trading unit, round lot, for all common stocks now listed on the exchange. Because in 1988 Berkshire had relatively few shares outstanding, 1,146,642, it did not have the number of 100 share or more holders that the exchange required. A 10 share holding of Berkshire, however, represents a significant investment commitment. In fact, 10 Berkshire shares have a value greater than that of 100 shares of any New York Stock Exchange listed stock. The exchange, therefore, is willing to have Berkshire shares trade in 10-share round lots. The exchange's proposed rule simply changes the 2,000 shareholder minimum from one measure by holders of 100 shares or more to one measure by holders of a round lot or more. Berkshire can easily meet this amended test. Charlie and I are delighted at the prospect of listing, since we believe this move will benefit our shareholders. We have two criteria by which we judge what marketplace would be best for Berkshire stock. First, we hope for the stock to consistently trade at a price rationally relative to its intrinsic business value. If it does, the investment result achieved by each shareholder will approximate Berkshire's business result during this period of ownership. Such an outcome is far from automatic. Many stocks swing between levels of severe undervaluation and overvaluation. When this happens, owners are rewarded or penalized in a manner wildly at variance with how the business has performed during their period of ownership. We want to avoid such capricious results. Our goal is to have our shareholder partners profit from the achievements of the business rather than the foolish behavior of their co-owners. Consistently rational prices are produced by rational owners, both current and prospective. All of our policies and communications are designed to attract the business-oriented long-term owner and to filter out possible buyers whose focus is short-term and market-oriented. To date, we have been successful in this attempt, and Berkshire shares have consistently sold in an unusually narrow range around intrinsic business value. We do not believe that a New York Stock Exchange listing will improve or diminish Berkshire's prospects for consistently selling at an appropriate price. The quality of our shareholders will produce a good result whatever the marketplace. But we do believe that the listing will reduce transaction costs for Berkshire's shareholders, and that is important. Though we want to attract shareholders who will stay around for a long time, we also want to minimize the costs incurred by shareholders when they enter or exit. In the long run, the aggregate pre-tax rewards to our owners will equal the business gains achieved by the company less the transaction costs imposed by the marketplace. That is, commissions charged by brokers plus the net realized spread of market makers. Overall, we believe these transaction costs will be reduced materially by a New York Stock Exchange listing. Transaction costs are very heavy for active stocks, often accounting to 10% or more of the earnings of a public company. In effect, these costs act as a hefty tax on owners, albeit one based on individual decisions to change chairs, and one that is paid to the financial community rather than to Washington. Our policies and your investment attitude have reduced this tax on Berkshire owners to what we believe is the lowest level among large public companies. A New York Stock Exchange listing should further reduce this cost for Berkshire's owners by narrowing the market maker's spread. One final comment. You should clearly understand that we are not seeking a New York Stock Exchange listing for the purpose of achieving a higher valuation on Berkshire shares. Berkshire should sell, and we hope will sell, on the New York Stock Exchange at prices similar to those that would have commanded in the over-the-counter market, given similar economic circumstances. The New York Stock Exchange listing should not induce you to buy or sell. It should simply cut your costs somewhat should you decide to do either.